So where do you want to go next?
Let's look at, I just pulled some quick numbers.
Great, let's do that.
If we want to go to the slides real fast. Pulled some quick numbers on what our daily expected move is based on our standard deviations. And so what I'm looking at here is that pound dollar. In recent months, we've seen the pound move a little more than the euro. The yen picking up as well. We're seeing 61 pips there. And on a day like today, with the FOMC and other major events, what can we expect to maybe double this range when we look at expectations? 1.5? What do we think? Because
good question.
When we're looking at this annualized, just pulled this. It's annualized. It's on a rolling 26-day basis, and so this is where we are right now, kind of evening out. But this was the last FOMC day where we did see this large spike, and so it's not ridiculous to want to pad your expectations.
This is a great piece of research because it really visualizes volatility as to, we talk about this 1.5 times the daily range, 2 times the daily range. Well, are you just pulling those numbers out of the air? No, you look at, okay, what did we get? We got an outsized move around these events. This is why we like to look at wrapping some statistics around it. So again, the key piece is, let's go back to the other slide, is, and this is where every trader on their risk profile, because there's no rate change coming from the U.S., but there is one coming from Canada, I would probably go 1.5 times on euro. Now, you want to be more conservative and give yourself a little bit more statistical edge. We know one standard deviation daily move takes place 68% of the time.
Right.
We know a 2 standard deviation daily move, or double this, happens 95% of the time. What does that mean? If I go 2, so in other words, I need a 96 pip move in euro to fade that move. That happens far fewer. So chances are you may not get what you want. Right. So you want to give yourself enough room so you can take advantage of the outsized elasticity. 1.5 will probably give you, just statistically, you're going to get that trade more often than not.
Right.
It's not going to be right as frequently as statistically as the 2 standard deviation. And this is really a matter of, what's your risk profile?
Exactly.
And the one thing is, if you want, I don't want to take the heat at 1.5. I want it to go statistically to a really outside. That's a good decision to make. Just accept the fact. Don't be disappointed like, if I moved it inside, I would have gotten it, and the market fell back. Think about these setups and using these as tools. You're either going to get something or not, and it's just strategy. You then say, okay, nothing moved the way I thought it would. We didn't get the outsized move. You pull those orders down. You move on to the next ones. The one thing I will say is that if you kind of wait for it to get up 90 and then say, okay, now I'm going to go, chances are you might miss it. So this is where you probably want to leave some limit orders and be mindful of either scaling in a little bit or whatever. Make sure it's a comfortable size for you and that your expectations are well set. You have 68% of the time is a great stats. If we could, again, in the world of betting, if you could find something where you could be right 68% of the time, it'd be gold.
I'd take that deal.
But 68 means you're wrong 32% of the time.
Right.
So you still have to manage. There's no guarantees. 95% means you have a greater probability, but 5% of the time it's going to continue to go. So still go through the exercise of, this is what I'm looking for, and this is where I'm going to manage when I'm wrong or where I'm right. But for me, 1.5 would probably be what I choose. And it's nice because cable at 1.5 gives you almost a full handles range.
Exactly.
So,
whereas, in that Aussie, on a percentage basis, this 26 pips isn't the lowest, but when you're managing expectations and you maybe are thinking the Aussie's going to rip a whole 100 pips, that number's not based in what we've seen historically. So,
so let me ask you this. You're absolutely right. So if I double it, it's 52 pips in Aussie. If I do 1.5 times, look at me, such a math whiz, it's 37 pips, whatever. Is that interesting?
I think it is. But again, that we've seen kind of play off with the risk on, risk off sentiment. And so there's a lot there as well, a lot of storylines to tie onto that as well. So when you talk about trading binary events and expectations, it's also important to realize what else could be at play. And maybe there are multiple drivers. And with the Australian session, when you're thinking about a day, maybe that day is a bit extended into the nighttime. And so while you could play the numbers in the U.S. session as it pertains to one standard deviation or two.
Okay, great stuff. We've gone long, so we got to wrap it up. But this is great because what you've done is give structure to the decision-making with a statistical basis. And I can't tell you how valuable this is. And we'll talk more about trade strategy around these and I've got the numbers. How do I start to flesh them out? This is great work, Glenn. Fantastic job. Guys,